You're listening to Capital Topics, episode number 69. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we'll review the 4 year-end tax planning strategies, highlighting the 2024 federal budget proposed change to capital gains tax. Enjoy! Hello, James. How are you today?
I'm very good, François. And how are you?
I'm fine, thank you. I'll start. It's that time of the year, again, to cover the year-end tax planning strategies for investors in capital market securities. Our regular listeners know this is an annual tradition on our podcast to cover this topic at year-end. But this year, the big planning challenge is that there is a lot of uncertainty surrounding the capital gains tax rules. Most of our listeners are well aware that the 2024 federal budget introduced major changes with the new capital gains tax rules. At the personal tax level, the capital gains inclusion rate was increased from 50% to 66 2/3 for gains realized over $250,000. The new rules for capital gains realized in corporation or in a trust are even harsher, whereby all realized gains will be taxed at the higher 66 2/3 inclusion rate. These new rules completely upend the planning for investor with assets in their corporation and for estates. To make matters more complicated, the new capital gains tax legislation is delayed, and some are speculating it may not be passed before year-end. There's a lot to discuss, and as usual, careful planning will be required. So, James, where would you like to start?
Well, François, to answer your question, I will tackle today's topic in two parts. First, I will address the new capital gains tax rules, and then in part two, I'll cover all the other year-end tax planning strategies that our listeners should consider.
Okay, great.
But before I start, I want to remind our listeners that when we talk about tax, we adopt the optimizing mindset, which is a very different concept from minimizing your taxes at all costs. By optimize, we mean you need to think not just about the current tax year, but how your assets will evolve over the longer term and how you will need to plan your current and or future retirement income withdrawals tax effectively.
Yeah. We want to remind our listeners that the insights and advice we will be sharing will be general in nature. We need a more detailed understanding of an investor's tax and financial situation to give specific recommendations. Listeners should consult their tax advisors, portfolio managers, and financial planners for personal recommendations. So, James, what should taxpayers do about the new capital gains tax rules?
Well, François, the political turmoil in the federal parliament has delayed the passage of the new capital gains tax legislation, as you highlighted in your introduction. And as we record this podcast, our thoughts and comments really are going to reflect this reality.
Mm-hmm.
But the question remains whether the capital gains inclusion rate increase will become law, as some opposition parties have made it clear that they would like to topple the government. There's a political risk that is difficult to assess at this point, but it could be that a delay or even a cancellation of the proposals could happen. The net effect would be to keep the current 50% inclusion rate.
Yeah, if an election is called before the capital gains proposal are passed, my understanding is the bill will die with all others not voted on before Parliament is dissolved or prorogued. This begs the question, how should Canadian taxpayers plan given this uncertainty, James?
Well, we've spoken with many tax professionals to answer that very question. Many investors proactively planned by crystallizing gains before the June 25th deadline at the old 50% inclusion rate, and they did that as if the proposals would become law.
Jane, is this usually the right thing to do?
Well, yes, I think it is. I mean, the Canada Revenue Agency is charged with administering the law, but the capital gains proposals, as we know, are not yet law. Should they become law, they will be retroactively in force as of that date.
Mm-hmm. Now, James, should taxpayers proactively file their tax return as if the new rules were law?
Well, François, tax specialists are saying that the CRA has no legal ability to assess tax returns on the basis that the capital gains proposals are law. In addition, the related tax forms and CRA-approved tax preparation software have not been updated or approved. So I would look to a recent Globe and Mail article that highlights the challenges faced by private corporations and estates with fiscal year ends on or after June 25th, 2024. And so I will share with our listeners some of the main points of that article. And I quote, with the CRA stating that tax forms won't be available until January 2025, taxpayers face two main challenges. Software providers can't release updates until legislation is passed, and filing and payment delays may result in interest and penalties for affected taxpayers.
So what should taxpayers do in the meantime, James?
François, the CRA recently provided some guidance via CPA Canada, the governing body that regulates professional accountants. And so the message the CRA is sending is that they encourage taxpayers to file affected returns based on the proposed legislation using a variety of different options. First, estimate and pay tax using the new 66 2/3 inclusion rate to avoid interest on the additional tax. File the tax return on time, even if uncertain, to avoid the late filing penalties. Monitor developments for possible legislative changes before year end. Fourth, work with advisors to prepare returns manually when and if necessary, although this is rarely recommended. And then finally, amend your return later if the legislation doesn't pass. So, again, a lot of tax specialists are up in arms about this. And recently, tax lawyer Kim Moody, writing in the National Post, recently stated, I have reviewed the CRA's suggestions and they make logical sense. In today's high interest rate environment, you would generally want to ensure that probable tax liabilities are timely paid so as to avoid possible costly interest charges. Currently, that rate is 9%.
Yeah. But what if the opposite happens, James? In other words, if you follow the CRA recommendation and proactively file and pay on the basis of the proposed legislation, but the new proposed rules never get passed, what happens then?
Well, again, what the tax specialists tell us is that in that case, you would need to file an amended return just to adjust for the correct amount of taxable capital gains and then request the refund for the overpaid tax. Now, of course, the CRA will also pay interest on such overpayments. What we all know, the interest they pay is lower than the one they charge, which is currently 9% for liabilities, as Kim Moody indicated in that quote. That refund rate is currently 7% for non-corporate taxpayers and 5% for corporations.
Yeah. I stated at the beginning of today's podcast that these new rules completely upend the planning for investors with assets in corporation and for estates. If the new rules come to be voted into law, what will be the long-term impact for investors?
Well, that's a great question, François, and that's really what investors need to pay attention to. So let's assume that these new rules are voted in and capital gains inclusion rate for investments in corporations are going to be taxed at 2/3. So, at a minimum, investors should determine whether it would be advantageous to withdraw amounts from their company in order to personally benefit from the 50% inclusion rate on the first $250,000 of annual capital gains, or if they should simply leave those amounts in the company for the long term. This question or analysis that's required to answer it, it requires careful planning with a professional tax accountant. To put things into context, I will summarize the taxation of passive investment income in corporations. When you earn passive investment income within your company, is taxed at a single marginal tax rate. In Ontario and Quebec, that's about 50.17%. There are no progressive rates. The tax on corporate investment income results in a potential refundable tax, and that's a whole nother complicated tax topic in itself. When your company pays dividends, it generally recovers this refundable tax. Once you've paid the tax on the dividends received personally, you can retain the net proceeds after the tax paid in the corporation and the tax paid on the dividends received personally from the investment income that was initially earned by your company. So for most investors, tax experts believe that it's still very advantageous, both short-term and long-term, to invest through their corporation.
This sounds complicated and counterintuitive, as the first 250,000 is taxed at the 50% inclusion rate personally, and in the corporation it's taxed at 66 and 2/3. Can you clarify this, James?
So, François, when business income that's earned in your corporation is used as an investment portfolio, you may have a lot more cash left over inside your corporation to invest than you would have if you paid yourself out a taxable dividend and then made personal investments. And this is simply due to the lower tax rates on corporate business income. So even though tax inclusion rate for corporate capital gains is quite a bit higher than the tax on personal capital gains earned personally that are taxed at 50%, below that $250,000 threshold, the extra corporate investment income more than overweighs that higher corporate capital gains tax.
Can you give us some example of what would be the net benefit for investors, James?
Well, interestingly, Jamie Golumbek, CIBC's resident tax expert, has produced a report that illustrates the net benefit for an Ontario resident. He estimates that if the corporation is taxed at the general corporate income tax rate, it would represent about 39% more accumulated after 30 years. And then when the estimate is based on the corporation being taxed at the much lower small business deduction tax rate, he projects there would be an almost 60% more accumulated after 30 years.
This is significant, James. We'll include a link for our listeners to the CIBC report. Some of our listeners may be asking themselves, would the new rules impact a business owner's decision to take money out of their corporation and contribute to their TFSA and their RRSP?
Again, another great question, François. We have always favored accumulating assets in the three buckets: the corporation, the personal account, and RSPs. Some business owners preferred, however, not to take money out of their corporation, but I suspect many who had previously favored investing in their corporations may now choose to withdraw income from their corporations to invest personally.
James, how will the capital losses be treated under the new capital gains tax rules?
François, capital losses carried forward from prior years will be worth more if you apply those losses against capital gains subject to the new higher inclusion rate. So again, careful planning required. Capital losses realized in 2024 must be applied against any capital gain realized in 2024. Excess losses can be carried forward. However, capital losses carried forward from 2023 or earlier can be applied against any future capital gains. So if you realize capital gains this year that will be taxed at the lower 1/2 inclusion rate, you may be best to hold on to your capital losses carried forward and apply them against gains taxed at the higher inclusion rate in future years.
So, James, if I understand correctly, investors should claim capital losses against the right gains and, where possible, sell your losers before year end.
Exactly, François. If you realize capital gains this year that will be taxed at the higher 2/3 inclusion rate, you should see if there are any securities that have declined in value versus what you paid for them and consider selling these before year end to offset the capital gains. Any capital losses realized in 2024 that can't be used to offset gains this year can be carried forward indefinitely to offset capital gains in the future. No change to that rule. Alternatively, the capital losses realized in 2024 can be carried back to last year, 2023, or 2022 or 2021 to offset the gains you may have declared in those years. Carrying losses back could recover some taxes paid in those years, but the savings won't be as great as using the losses against future capital gains at the much higher capital gains inclusion rate.
Mm-hmm. If you're selling a loser, the settlement date must fall in 2024, which means placing your trade on or before Monday, December 30th for publicly traded securities that settle one day after the trade, which this became the norm on May 27, 2024. As year-end approaches, clients may also consider making in-kind donation of appreciated publicly traded securities. For high net worth clients with gains above $250,000 in a year, the strategy must be very attractive now, James.
Well, the strategy is attractive at the 50% inclusion rate. It's even more so at 66 and 2/3. So if you donate publicly traded securities or mutual funds to charity, you'll receive not only a donation receipt for the fair market value of the gift, but any capital gain on the security will be subject to a zero inclusion rate, eliminating the tax on the capital gain.
So in summary, James, we don't have to pay the tax on capital gains, and we still get our charitable donation receipt to use on our personal tax returns.
That's exactly right, François.
Yeah. Okay. Okay, let's tackle part two. What are the other year-end tax planning strategies our listeners should know about, and what actions should they take before December 31st, 2024 regarding the registered accounts, RRSPs, TFSAs, RESPs, and the new FHSA?
Well, first off, much of the content of last year's podcast on year-end tax planning is still very relevant this year. I recommend our listeners go back to podcast number 58 and listen to it. To answer your question, François, I will first start with RSPs. So the current RSP maximum contribution room is $31,560. Listeners can find their RSP room on their 2023 Federal Notice of Assessment. This number will include unused contribution room carried forward from prior years. The 2025 maximum RSP contribution will be increased to $32,490 for those listeners who like to make their early bird contributions at the beginning of the year. For business owners, consider declaring T4 salary of at least $180,500 by December 31st, 2024. This will create the maximum RSP contribution room, as I stated earlier, $32,490 in 2025. If you've turned 71 this year, you must convert your RSP to a RIF, and you have until December 31st to do so. But don't forget to make any final contributions to your RSP before converting it.
Right. What do you have to share now about the TFSAs, James?
Well, the tax-free savings account, again, have a lot of planning points to them. The TFSA dollar limit for this year, 2024, was increased to $7,000, but there's no deadline for making a TFSA a contribution. Unused contribution room is simply carried forward.
Mm-hmm. Right.
The CRA has announced the limit for 2025 will not be increased and will remain at $7,000. So again, for most investors, if they have the money, it's always best to make your contribution as early as possible in January. For listeners who have not maximized their TFSA since 2009, again, you can check online with the CRA website to confirm your contribution room. The maximum room since 2009 is $95,000 as of this year, and that's assuming you never made a contribution. So if you haven't invested in your TFSA, you should really start to think doing it, because that's very, very, there's nothing better, as I say to clients, than paying no tax legally. But be careful. If you've withdrawn funds from your TFSA this year, you must wait until next year to recontribute the amount withdrawn. If you are planning a TFSA withdrawal in early 2025, you might want to consider alternatively to withdraw the funds, late this year in November or December, so you don't have to wait until 2026 to recontribute the amount.
Okay, so next up is the First Home Savings Account. We covered this topic in detail in our podcast number 52, published in 2023. So what do you have to say here, James?
Well, the First Home Savings Account is a very interesting and generous plan. All young people or older people considering buying a new house should look at this. But the rules are complicated. First off, François, you must verify if you qualify to open a First Home Savings Account. You can visit the CRA's online website to make sure you meet the requirements. In 2024, your contribution cannot exceed $8,000 if this is the first year to make a contribution to your FHSA. If this is your second year and you contributed the maximum $8,000 in 2023, then you can contribute another $8,000. You can claim a tax deduction for contributions within this limit in 2024 or in a future year if not claimed previously. Unlike RSPs, contributions you make within the first 60 days of 2025 cannot be deducted in 2024.
Yeah, the FHSA rules are quite complicated. The 2024 contribution must be made before December 31st to be deductible in 2024. It's best to seek out expert advice on this. Now let's talk about RESPs, James.
Again, another complicated, technically challenging program. So I'm going to summarize the key RESP planning points. Again, parents contribute. They get Canadian Education Savings Grant. In Quebec, you get an extra 10% provincial grant. So that you contribute the $2,500, or you can do another $2,500 of catch up for a total of $5,000 to generate the maximum grants in a given year. If you have less than 7 years before your beneficiary child turns 17 and haven't maximized RESP contributions, consider contributing by December 31st, because otherwise you will not be able to claim the maximum of $7,200 in federal government grants. That is $7,200 per beneficiary child. For our ESP withdrawals, the maximum education assistant payment, EAP, that can be taken in the first 13 weeks of post-secondary education is $8,000 for full-time students and $4,000 for part-time students. Finally, for RESPs, if your child is a beneficiary of the plan and stopped attending a post-secondary educational institution in 2024, EAPs can only be paid out for up to 6 months after the student has left the school. You may therefore wish to consider making a final EAP withdrawal for that beneficiary before year-end, especially as they may have to pay much higher taxes in 2025, assuming they're going to have a full year of employment income.
Right. Do you have other year-end suggestions for listeners, James?
Yeah, well, we always come out with these two. You should never forget to pay your investment expenses to claim a tax deduction or credit in 2024. This includes interest paid on money borrowed for investing and investment counseling fees incurred for managing non-registered accounts. And then there's the all-important old age security clawback. Make sure that you plan your income to try and avoid having it having to pay some of it or all of it back. Again, it's a form of double taxation. This year, taxpayers must repay their old age security at the rate of 15% of 2024 net income, starting at a threshold of $90,997. So they've increased the threshold. The entire amount must be repaid if a taxpayer has a net income of more than $148,451 for taxpayers between ages 65 to 74, or if the taxpayer has net income more than $154,196 and is age 75 or over. So again, this is a means test that also amounts to a form of double taxation, as I said earlier. And because old age security is an individual benefit, it is not impacted by family income, but instead is clawed back based on an individual's taxable income. So again, there's planning opportunities. You have to be careful to look at this at year end.
Anything else, James?
Yes, I do have something else, François. As we've said many times before in our podcast, tax planning should be done all year long. Do not wait for year end to optimize your taxes.
Indeed, James, and I hope they do. I believe we have covered a lot of ground, and hopefully our listeners will find this update very useful. I also want to remind our listeners that our comments and advice on this podcast are generic in nature, and all our listeners should consult their tax and financial advisors. So, James, thank you for your expertise and knowledge today.
My pleasure, François.
So that's it for episode number 69 of Capital Topics. Don't forget, if you'd like to submit question or suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on December 18th. In the meantime, make sure to consult Capital Topics website for our latest blog posts. See you soon.